Only 2 silver bars moved inside the COMEX vaults. Just 2. In a market where billions of dollars in silver contracts change hands every single day, that number shouldn't even be possible. So, what are the world's biggest institutions seeing that ordinary investors aren't? At the very moment physical movement nearly stopped in America, China quietly began forcing something that could change the future of precious metals forever. Is this simply another slow trading day? Or is it the first visible crack in a paper market that has controlled silver prices for decades? Because if physical reality is finally starting to challenge paper promises, what happens next may surprise almost everyone. Stay with us. Welcome to Next Alert, where we break down the world's biggest economic stories into clear, practical analysis you can actually understand. If you enjoy thoughtful market insights and want to stay informed about gold, silver, the global economy, and the forces shaping your financial future, we'd be honored if you subscribed and became part of our growing community. Your support truly helps this channel continue bringing you in-depth analysis. Before we begin, we'd also love to know where you're watching from today. Tell us your country or city in the comments. We always enjoy seeing how far the Next Alert community reaches around the world. Now, let's uncover why the movement of just 2 silver bars may be telling a much bigger story than anyone expected. The latest COMEX warehouse report appeared so ordinary that most market participants barely noticed it. Hidden among rows of inventory figures was a detail that seemed almost insignificant. Only 2 silver bars had moved into a registered depository during the reporting period. In isolation, that statistic looked like little more than a routine operational update. Yet experienced commodity analysts understand that markets often reveal their most important signals, not through dramatic headlines, but through unusually quiet data. At first glance, silver prices continued behaving as they usually do. Traders responded to inflation expectations, interest rate speculation, currency movements, and geopolitical developments. Futures contracts worth billions of dollars changed hands throughout the trading session, creating the impression of a healthy and highly liquid market. Anyone looking only at price charts would likely conclude that business was continuing as normal. However, beneath the surface, a very different picture was beginning to emerge. COMEX, the commodity exchange in New York, serves as one of the world's most influential pricing centers for precious metals. Every day, enormous volumes of silver contracts are bought and sold between financial institutions, hedge funds, mining companies, refiners, industrial users, and speculative traders. These contracts determine benchmark prices followed across global markets. Yet there is an important distinction that many new investors fail to recognize. Most silver traded on COMEX never changes hands physically. Instead, the majority of transactions involve paper contracts representing future delivery obligations rather than immediate transfers of actual metal. For many participants, these contracts are simply financial instruments used to manage risk or speculate on future price movements. Physical delivery remains the exception rather than the rule. This difference between paper trading and physical ownership lies at the center of today's story. Every COMEX warehouse report separates silver inventories into different categories. One of the most closely watched is registered silver, metal that is immediately available to satisfy delivery obligations if contract holders choose to receive physical bullion. Another category, known as eligible silver, consists of privately owned metal stored inside approved vaults, but not currently committed for exchange delivery. Understanding this distinction is essential because inventory levels provide insight into the relationship between financial trading activity and available physical supply. When warehouse movements become unusually small, analysts begin asking important questions. Has demand for physical delivery weakened? Are institutions choosing to hold on to their inventories? Or is the market entering a period of unusual caution while participants wait for larger economic developments? No single warehouse report can answer these questions on its own. Markets are dynamic systems influenced by countless variables every day. Still, history shows that periods of remarkable silence sometimes precede significant changes in investor behavior. That is precisely why the movement of only 2 silver bars has attracted attention among experienced observers. The issue is not the quantity itself. The issue is the contrast. Billions of dollars in paper contracts continue circulating through financial markets while almost no physical silver changes location inside one of the world's most important delivery systems. Such a gap naturally raises questions about how closely financial trading reflects conditions in the underlying physical market. For long-term investors, warehouse reports often reveal information that daily price charts cannot. Prices react quickly to headlines, expectations, and short-term speculation. Physical inventories, on the other hand, reflect slower structural trends involving production, storage, industrial consumption, and delivery demand. Watching both together provides a more complete understanding of market health. At the same time this unusually quiet COMEX activity was unfolding, another development was taking place thousands of miles away. Across Asia, particularly in China, policy decisions were beginning to place greater emphasis on physical precious metals rather than paper exposure. On the surface, these events appeared unrelated, but as the evidence continued to accumulate, a broader pattern started to emerge. The real question was no longer why only 2 silver bars moved. The more important question was whether the global precious metals market was quietly beginning to shift from financial promises toward physical reality. Markets rarely announce the beginning of a structural shift with flashing headlines. More often, they whisper. While investors around the world focused on silver's daily price swings and the unusually quiet activity inside COMEX warehouses, another development was unfolding thousands of miles away, one that received far less attention but carried potentially far greater consequences. China was beginning to redraw the line between paper ownership and physical ownership. Unlike the routine fluctuations seen in commodity markets every day, this was not simply another regulatory adjustment. It reflected a broader philosophy about how precious metals should function within a modern financial system. Several major Chinese financial institutions started restricting retail paper precious metals products, encouraging investors to either close their positions or transition toward physical settlement. At first, the decision seemed directed almost entirely at gold, but seasoned market observers understood something important. Gold and silver rarely travel completely separate paths. Their markets are deeply connected through investor psychology, monetary policy, industrial demand, and global capital flows. When one side of the precious metals ecosystem begins emphasizing physical ownership over paper exposure, attention naturally turns to the other. That is why the developments in China deserve far more attention than a typical regulatory headline. They may not change global pricing overnight, but they could gradually influence how investors, institutions, and even governments think about precious metals in the years ahead. This raises a larger strategic question. If one of the world's largest economies increasingly favors physical accountability, what happens to markets that have relied for decades on financial contracts, settling without actual metal-changing hands? That question becomes even more significant when viewed alongside COMEX's unusually quiet warehouse activity. Individually, each event may appear manageable. Together, they begin telling a very different story. One market is showing remarkably little physical movement. Another is encouraging more physical participation. Whether those two trends eventually intersect remains uncertain, but they are now moving in directions that deserve careful attention. And as China's industrial appetite for silver continues expanding through electric vehicles, advanced electronics, artificial intelligence infrastructure, and renewable energy technologies, the importance of securing reliable physical supply becomes increasingly difficult to ignore. The market may still appear calm, but beneath that calm, the foundations of global precious metals trading could already be evolving. Imagine waking up to discover that thousands of investors are asking for something the market has spent years treating as almost optional. Not another futures contract, not another ETF share, not another paper claim linked to the price of silver. They simply want the metal itself. For decades, the modern silver market has operated on an assumption that very few participants will ever request physical delivery. Most traders enter in exit positions long before contracts reach settlement. They profit from price movements, hedge business risks, or manage portfolios without ever expecting a single ounce of bullion to arrive at their door. That assumption has shaped the entire structure of today's market. It is one of the reasons trading volumes on paper exchanges can exceed the amount of physical silver available for immediate delivery by many times over. Under normal conditions, this system functions efficiently. Buyers and sellers receive liquidity, producers manage future production, manufacturers lock in costs, and investors gain exposure without handling physical metal. In many ways, paper markets make global commodity trading faster and more flexible. But every financial system depends on one critical condition: confidence. Confidence that contracts will settle as expected. Confidence that enough physical supply exists if delivery is required. And confidence that participants will continue playing by the same rules tomorrow as they do today. The challenge begins when those assumptions start changing. If more investors suddenly prefer owning allocated silver instead of paper exposure, warehouse inventories become far more important than daily trading volume. Analysts stop asking how many contracts changed hands and begin asking a different question altogether: how much deliverable silver is actually available? That is precisely why experienced market professionals monitor registered inventories, open interest, and delivery requests together rather than individually. A quiet warehouse report means very little by itself. Large futures activity means very little by itself. But when enormous financial exposure exists alongside relatively limited, immediately deliverable inventory, market observers naturally begin measuring the balance between promises and physical supply. History has shown that commodity markets rarely experience stress because everyone demands delivery at once. Instead, pressure builds gradually, industrial demand increases, central banks accumulate reserves, governments adjust policy, investors become more cautious, And over time, the relationship between paper claims and physical availability begins attracting far greater attention than price alone. Whether today's silver market reaches that point remains uncertain, but the conversation is no longer limited to traders searching for the next price movement. It has become a discussion about market structure itself and whether the balance between financial efficiency and physical accountability is beginning to change. As this analysis comes to a close, one conclusion becomes increasingly difficult to ignore. The movement of only 2 silver bars was never the story. It was simply the clue. Financial markets often attract attention with dramatic price swings, breaking news, and bold predictions. Yet some of the most important changes begin long before they become visible on a price chart. They begin in inventory reports, policy decisions, shifts in industrial demand, and the quiet actions of institutions that rarely explain their strategy publicly. That is why serious investors look beyond daily headlines. The silver market now stands at the intersection of several powerful forces. Industrial consumption continues expanding as technologies such as artificial intelligence infrastructure, advanced electronics, electric vehicles, and energy systems require increasing amounts of the metal. At the same time, central banks around the world continue reassessing monetary risk, while geopolitical uncertainty encourages many investors to diversify into tangible assets. None of these developments guarantees dramatically higher silver prices. Markets rarely move in straight lines. Periods of optimism are often followed by corrections. Unexpected economic slowdowns can reduce industrial demand. Interest rate decisions can strengthen or weaken investment appetite. Even strong long-term trends frequently experience significant short-term volatility. That is why prediction should never replace preparation. The more valuable question is not whether silver will rise next week or next month. The better question is whether investors understand the structure of the market they are participating in. Those who own physical bullion, exchange-traded funds, mining shares, or futures contracts are not necessarily holding the same type of asset. Each serves a different purpose, carries different risks, and responds differently during periods of market stress. Understanding those differences has become increasingly important. If physical demand continues growing while available inventories remain relatively tight, market participants may begin paying closer attention to warehouse reports than ever before. If supply chains remain stable, the current system may continue functioning much as it has for years. Both outcomes remain possible. That uncertainty is exactly why disciplined investors avoid making decisions based solely on headlines. Instead, they monitor the indicators that reveal deeper market conditions. They watch COMEX registered inventories. They follow Shanghai premiums. They observe delivery volumes, industrial consumption, mining production, central bank activity, and major policy changes from the world's largest economies. Together, these indicators often provide a clearer picture than price alone. China's increasing emphasis on physical precious metals may prove to be an important milestone, or it may simply become one chapter in a much longer evolution of the global bullion market. Likewise, today's unusually quiet COMEX activity could be remembered as an ordinary warehouse report, or as an early signal that physical markets were beginning to matter more than many investors realized. Only time will answer that question. And what remains certain is that markets reward preparation far more consistently than prediction. For business leaders, investors, and entrepreneurs, the lesson extends well beyond silver itself. Every market eventually reaches moments when underlying fundamentals begin speaking louder than short-term sentiment. Those who recognize those signals early often make better strategic decisions than those who react only after the headlines arrive. So perhaps the most important takeaway is not that only 2 silver bars moved. It is that a statistic most people ignored forced a much bigger conversation about the future of global precious metals markets. And if physical reality continues gaining influence over paper promises, the next major chapter in the silver market may already be quietly unfolding, long before the rest of the world notices. Thank you for watching Next Alert. If you found this analysis valuable, consider subscribing for more in-depth coverage of precious metals, global markets, and the economic trends shaping tomorrow's financial landscape. And before you go, share your perspective in the comments. Do you believe the future of silver will continue to be driven by paper trading? Or is the world gradually moving toward a market where physical metal once again takes the lead?